S&P 500 just a little shy of 60.50 right now. Kevin Grain joining us for a look at the levels of the options trades. KG, technically, are we running into a wall here? Is it options based? What's going on?
Yeah, it is actually a pretty decent wall here at the 60-50 level. Now, we had this on the radar this morning as that intermediate area of resistance that we could see in the market, and it's been an area that has been highlighted over the last couple of trading sessions here. But we do have a lot of volume at that 60-50 call level, Oliver, over 100,000 contracts traded on the session. And if we make the assumption, like we do every day, that these calls, once again, are kind of being sold at this point in time, you're looking at the notational, gamma risk level here, sitting at around close to $150 billion. That's an estimate. So obviously there's a lot of assumptions that are going into this, but it does represent that there's obviously something there when it comes to positioning. And so I would be very remiss to say that maybe we can break above it. Anything is definitely possible, but I'm not seeing any type of aggressive call buying activity above that strike. You could look at the 60-60 level that was getting some love earlier today, not so much now. So we might have some pin action at this level. We might see a little bit of a fade at this level, but a lot of exposure.
It looks like the most unimodal curve, really, that we've seen in a while to have so much of the action happening right there. Am I imagining that, or is that true?
No, you're right. I think this is probably one of the higher levels that we have seen since doing this segment. 150 billion. When you have over 100,000 contracts being traded, you can get really outsized. Now, this graph is also very notable as well. I have not changed the distribution method of these, of this curve here, which just means that there's a lot of concentration. We kind of talk about compressed markets. This is the compression. You're looking at maybe a 10-point to maybe 20-point swing to the upside or downside for the major negative gamma level, meaning the major positioning on the downside and that major positioning to the upside. So this is just compression. Now we're inching up on a day-by-day basis, which is great, but it's not really filling out. So a lot of concentration right now. And if this continues, I would suspect that we might see more days where we have 10-point, 15, 20-point ranges, which is a very boring market if you're an intraday trader. You'd like to see a VIX up a little bit higher, 17, 18 VIX, and you'd like to see 40-point ranges throughout the day. That's easier to scalp than 10 points or even 5 points to the upside or downside.
All right, and we do have this higher lows going for us. So, I mean, it still seems like when push comes to shove, bulls have got the edge.
A tad bit, yeah. I would say the advanced decline line is a little bit lackluster here today. We are seeing a lot more concentration when it comes to the mega cap names leading the market to the upside here, but that's the environment that we are in. So I'm right there with you. I mean, the bulls definitely have a lot of fuel to go here to the upside. But when you're looking at the options volume for today, Oliver, and we're going to break this down a lot more tomorrow morning. So hopefully people will watch this because you actually did see a lot of institutional positioning moving out for the first quarter of next year. And that's what I found very interesting for today. You're starting to see a lot more put spreads being put into the market. There is, a big institution that is maybe suspecting that we might see a little bit of a pullback by January 3rd. And then you see a lot of VIX call selling basically in the January, February, and March expiration at very high out of the money call levels. You're looking at 50 strikes and up. They're basically getting in pennies, but today was actually that structured positioning type of volume that you'd like to see. And I think that we will probably see a dynamic shift in these levels for open interest going into tomorrow.
Okay. So we got the wedge that we're hanging on to. Got advanced decline that's seen worse days than this, but, obviously a little bit of chop. Kind of seems like generally up and to the right, still the direction that we're going once we got past that 6K. So it seems like I won't get too worried until we're like slipping into the 5 handle again. It's, reasonable to expect, I would think, some real good support down there.
Yeah, 59.90 would be the area that you'd like to, I mean, if you kind of look at it from a technical standpoint, you'd like to come back and try to retest. I would even say even coming back and retesting 6,000 and pushing higher would actually be healthy for the market right now. But you kind of want to avoid going below 59.90, at least through the remainder of the year. Now, it's only 50, 60 points away from here. We could have that in a matter of a day or 2 days. But if we continue to melt up in this type of fashion for the remainder of the year, I mean, once again, the Bulls definitely have the advantage for right now. And then I would suspect, that obviously, actually in January, we might see a little bit more volatility, just based on the flows that I saw this morning and throughout the day, looking at the January expirations. A lot more bearish tone for January than bullish. So I would put that on the radar for a lot of people out there.
Interesting. Okay. Good stuff. Thanks, Kevin Green.